right, first things first then, valuation markdowns, be it the likes of Byju's, Koo, Ola. There have been a number of companies that have been at the receiving end of this. But what exactly does this mean? Is this dark clouds for the startup sector? Or is it an opportunity to reboot and put the focus on profitability? Joining in right now is K Ganesh, promoter Bigbasket, Bluestone and Portea Medical, joining in to discuss that and more. Thanks so much for taking time out. So clearly, we are seeing that shift that is taking place in the funding dynamics away from just growth at any cost to now a lot of startups having to take cognizance of their financials. Nearly 49% in terms of the Indian unicorns have lost their value on average. What do you make of this scenario?
Yeah, that's a great question. Right? I think there are two kinds of companies, problems, or issues that we are seeing now. One is markdown in valuations. Right? That's one part of it. The other one is challenging business model, relevance of the business models in the post-pandemic era. We should take these two separately. Let's talk about the valuation markdowns. See, valuation markdown is not a major concern for me because it happens in even public markets. A lot of stocks, including the top tech stocks, have corrected globally also and in India. So that is a function of demand and supply, because of which valuations come down. Firstly, nobody said those euphoric valuations of $10 billion, $5 billion, $6 billion was correct or logical or defensible. Yes, it was great for the entrepreneur and the company at that time because they were able to raise money at those valuations. It was not good in hindsight for the people who invested at those valuations. But minus that, that was not reality. That was a function of demand supply euphoria that existed, and therefore it got it. Now it has got corrected. One can argue it has got corrected to the right level. So other than the investor who came in only at that high valuation, nobody else is crying. It doesn't affect anybody else. Optically, it looks like, oh, the company's raising money at a lower valuation, but that's perfectly fine. Slightly additional nuance, there are investors who have marked down their valuations in their books. And many investors have marked it down to different levels. Now, that's a paper transaction. That's a transaction in which an existing investor, as per the principles of conservatism, as it's required by their mandate, are marking down in their books. That doesn't mean a transaction has actually taken place for them in that particular value. So even with this nuance, I'm not very concerned. So that's the first aspect. The other aspect is post-pandemic, clearly certain business models have taken a hit. Post-pandemic return to normal has affected some of the sectors very, very strongly, EdTech being one, telemedicine being the other. We have seen that. So or even social media, like the Koo example that you talked about, where it was seen as an alternative to Twitter, a domestic Indian alternative to Twitter. Those business models are getting seriously challenged. That definitely is a cause of concern for me, saying that, can you actually have Twitter for India, an independent business model like Koo? Or for that matter, even in EdTech, how much of EdTech really will work in a post-pandemic scenario when people have gone back with a vengeance to face-to-face thing? So I think these are two separate aspects. First one, not a concern at all. Second one, yes, concern of certain business models when return to normal has happened.
So what exactly do you believe are the factors that are contributing to this? Would it be regulatory challenges, largely profitability concerns, competition, etc.?
No, definitely they are critical. If you take, for example, the fintech sector, insurtech sector, where RBI has been continuously coming up with newer regulations, there it has been a challenge. We have seen with companies like Paytm and others where the RBI action has affected their business. Now, uh, obviously, RBI or the regulator has to protect the larger interest. I think they are doing a great job, not stifling innovation, but at the same time, not letting things go berserk because you're allowing a free rein to startup. So they are playing a balancing act. Now, for startups, which are by nature disruptive, by nature agile, will fail fast. In sectors like fintech, they need to work within the boundaries of regulation. E-commerce is easier, delivery apps are easier because regulations are not really applicable there, not too many regulations apply. But when you're talking about highly regulated sector, like fintech, insurtech, others, where you have a regulator, where public money is involved, startups have an additional responsibility of trying to uh, play within the rules, despite wanting to innovate and despite wanting to disrupt. So this is a tussle from two sides that go on. Some of the initiatives like regulatory sandboxes, where the regulators and the government have allowed limited amount of experimentation within acceptable limits, is a good solution forward. So this is evolving. As we see, more and more regulations will become clear. Only thing I would expect from the government and the regulator is stated upfront, be clear and transparent right at the beginning, so that startups don't unnecessarily end up spending too much time or effort going down in a certain way. Something like the what happens with the payments bank could have been avoided at a much earlier scale than later scale. Because when things happen at a much later stage, then it affects most of the players in the ecosystem. The customers get affected, the investors get affected, the employees get affected, the vendors get affected, the company gets affected, obviously the entrepreneurs and the promoters get affected. So everybody gets into a tizzy if the same intervention, regulation, regulatory action happens at a later stage. It could have been done at an earlier stage. That's the only suggestion that I have.
Now, while of course a valuation markdown brings about short-term challenges, do you think that in a large way or in the big picture, it serves as a reality check almost, a catalyst to really make changes, reboot? Now, startups will be forced to really reevaluate their strategies, their cost efficiency, their operations, their profitability metrics.
Yes, absolutely. I think each of these changes is good, good for the ecosystem, good for the company, good for the entrepreneur, good for uh, all the stakeholders, right? Obviously, this is not the first time it's happening. This cycles of huge euphoria, run up in valuations, large ticket sizes, and followed by deep gloom and doom, where the funding dries up. We call it funding winter. The valuation dries up. The ticket size dries up. Uh, the typical angel investors no longer operate. They go to all the angels go to heaven. This cycle of up and down continues to happen. It's good for the ecosystem because the bubble bursts, and the quicker these cycles of boom and bust happen, the better it is for everybody to do a reality check. What is obviously currently we are in an environment where the focus is on profitability. Investors prefer profitability, path to profitability, prudence to uh, uncontrolled growth. Earlier, they were rewarding market share growth at the expense of every other metric. Now, their focus is completely on profitability, convergence, path to profitability with some responsible growth. I'm sure this will again change and we'll again get back to euphoria. But each of these cycles helps in resetting the expectations of everybody, also ensuring that the bubble doesn't become too big before it bursts. So I think it's extremely positive. What has also got added to this now is two factors. One is the change in consumer behavior, a return to normal post pandemic. And two, we had an unprecedented time of free money, easy money, low interest rate, lot of money chasing. Okay, right? And both of them got combined. So it raised the level of the bubble or the top of the bubble to a very large extent. So what we are seeing now, the reason we are discussing this, we are seeing a sharp drop. Earlier, the up and down were not so sharp as it is now. Hopefully, we have seen the worst of it. Again, I'm sure a bubble will come, things will go up, it will come down, but perhaps in a more tempered fashion than this high euphoria and therefore the sharp drop. That always affects the startup ecosystem because you hear about layoffs, you hear about changing business models, hear about markdowns, all of that stuff creates unnecessary noise. Hopefully, we'll see less of this in the corrections in the future.
So what exactly then would be the message for a lot of these startups, and what is your outlook for the year ahead in terms of what we could see as the new companies making it to the public listing?
Oh, I think we are, again, I'm as an entrepreneur, I'm always optimistic. We are all optimistic entrepreneurs. I am extremely bullish on some of the sectors in the coming year. I see a lot of businesses being built on generative AI and applications of generative AI. And it's a great opportunity for Indian entrepreneurs. It's much bigger opportunity than what SaaS was 10 years back. We have seen buildup of horizontal SaaS, vertical SaaS, so many SaaS startups from India for the global world. I see the same opportunity in generative AI space. This, where you take any application, use generative AI and build the application and take it to the world, I think it's a huge opportunity. Take, for example, robotics process automation. That again is a great example. So deep tech as a space and the ability to leverage generative AI is a great example. Other one is just the clean mobility, electric vehicles. I'm not saying make the car or make the scooter. The derivative of whether it's a battery technology, whether it's recycling, whether it's charging infrastructure, the opportunities which derive out of clean mobility, green mobility, the sectors offers you multiple startup opportunities to build on. So this is the best time, and talent is available at a reasonable cost. We are not in euphoria. This is the time to actually build sensible startups, raise small amount of money. There is enough dry powder available, enough money available waiting to be deployed, but not at euphoric valuation, not for growth startup. You'll have to show a good path to profitability, sensible business model, enough money is available. Investors who have raised money from LPs are sitting on a lot of money. So if you're an entrepreneur, lot of things are aligned in your favor at this time to start a business. Talent, capital, sensible expectations from investors to build a profitable, unit economics positive business. So all of this. So go ahead and build a business now. Don't get carried away by media. Don't worry about drop in valuations, unicorn losing valuations. All of that doesn't matter to you. See an opportunity, leverage on what's happening in the ecosystem, like generative AI, like clean mobility.
All right, thanks so much for joining in and sharing with us that outlook.
If you like this video, then like, share and subscribe to ET Now.